I want to welcome everybody to this panel. It is one of the most fascinating that I can imagine because we're talking about the role of finance in a recovery before a downturn has happened at a time when everyone's debating whether a downturn will happen. And we have panelists who can really discuss where they see the financial economy and then the role of their businesses, of their visibility into the economy fits in fostering innovation at a time of restraint. I want to introduce our incredible panel. And honestly, this is truly an honor. We have François Villeroy de Galhau, almost got it right, the governor of the French Central Bank. Almost, but we're going to call you governor for the rest of it. We have Miebach. Did I do that pretty well? But I'm going to call you Michael for the rest of it, who is the CEO of Mastercard. We have Roelof Botha, the managing partner over at Sequoia Capital. And we have Adena Friedman, the head of Nasdaq, all here to talk about a very fraught situation. So I want to start with this question. Are we headed to a downturn? How far away are we? And Governor, I would love you to start.
Thank you very much, Lisa. So we have a slowdown without any doubt. We expected it, and we know why. It's due, among other factors, to this ugly Russian war in Ukraine. It led to higher inflation and lower growth. But if I look at the last news, activity is more resilient than what we expected, let's say, 3 months ago. I speak for Europe and probably for the US. And I would say that for Europe, we should avoid a recession this year, which I wouldn't have said with such confidence 3 months ago. The other front, which plays a very important role, is inflation. We will win, at the end of the day, the battle against inflation, have no doubt about that. I take this commitment on behalf of the ECB. We will bring inflation back towards 2% by the end of 24 or 25, but this battle is not yet won. So we will stay the course on monetary policy. We will still increase rates. I hope we will be by, or I wish we will be by neutral rate, a terminal rate by next summer. So activity resilient, inflation under great vigilance.
Okay, so you have...
It has peaked in the US. And it will peak in Europe in this first half, first on headline inflation, and then on core or underlying inflation, excluding energy. But we remain very determined.
So high rates, but no recession, at least not this year.
Let me say higher rates.
Higher rates? Okay, we'll get into that. All right, but Michael, what's your view? Do you think that seems plausible to you, that we could get higher rates from here, but no recession this year?
Right. So the governor talked about Europe. Let me zoom out a little bit and take a global view on that answer. The answer is pretty simple. It depends on where you are. If you're in Europe, the answer might be, as the governor said it. If you look into Asia, if you look into North America, the playout could be very different and really comes down to what is the policy response, what is the response of the respective central banks, what is the construct of the economy, do we have natural energy prices rising, whatever the circumstances are. When we look through the lens of the consumer, which is we're uniquely positioned to have data about where the consumer stands, what we're expecting is a relatively mild economic cycle at the aggregate. So why is that? You got a bunch of gives and takes depending on which region. To the governor's point, inflation rates are likely to be elevated, but we're seeing at the same time relatively low unemployment. We're seeing strong consumer balance sheets. We're seeing agile consumers, depending on where you sit on the income segment. Obviously, at the lower income segment, you're going to be hurt by higher rates. That's for sure true, by higher prices, therefore. But people are making trade-offs. They make ends work. So after 2 years of being locked up, people want to go out and have experiences, go to restaurants and do things, and they do that. They do that by buying less goods, which is what they did for over the last 2 years. One common trend across the board is that spending on essentials versus discretionary spend has been increasing, but within that, the consumer is trying to make trade-offs. Headline, the consumer is resilient. We're not seeing any signs of a recession at this point. As we look ahead, the gives and takes, and depending on where you are.
So right now, probably no recession, at least in Europe. Maybe no recession in the US. Looks like it's pretty full steam ahead. Roelof.
So our business is mostly funding young startup companies. And so to some extent, the recession doesn't have a big role to play. And certainly when I was at PayPal back in 2000, in the midst of the dot-com meltdown, what mattered was just building a business and figuring out a business model and serving customers. So it doesn't affect our business that directly. And I'm not a macroeconomist, but I serve on the board at Block, formerly known as Square, with Larry Summers. And listening to him this morning, when you think about how tight the US labor market remains, how wage inflation stays stubbornly high, and how the Fed is determined to get inflation under control, it seems more likely that we'll overshoot interest rate rises, which means that we're likely to face a mild recession at the end of the year.
So what consists, and I will get to Adena in 1 second, but what consists of an overshoot? Because we just heard from the governor over here saying that rates are going to go up from here, but there still is going to be no recession. What's an overshoot?
Well, if you look at, the argument would be that there are very few soft landings, and that Powell is very determined to be in the footsteps of Volcker and wants to show that the Fed can control inflation. And so if anything, they will over-tighten, and that will lead to ramifications. So the labor market has been very tight in the US, but that can change very, very quickly. And as the balance sheets start to deplete from all the fiscal stimulus we had during COVID, eventually that runs out. People will start to look for jobs right at the time that people will stop hiring. And that may lead to a snapback and a deeper recession I think some people are expecting.
Adena, what do you see from your vantage?
I'm more optimistic than that right now. I mean, I think that I've become more optimistic as I've seen the resilience of the consumer, as we've been talking about. I also think that I particularly think that we're nearing the end of the interest rate increases for now, based on the fact that you are starting to see inflation decline in the United States. I think that we're going to see that as a sustainable pattern, and that's going to make it so that the Fed has more confidence that we'll still see increases, but I think they're going to, I'm hopeful that in the next four months or so, we could actually see the peak rate for at least for now. I think there's one wild card that we haven't yet talked about, which is the return of the Chinese consumer and the Chinese economy. You know, as they manage through COVID, which is a personal tragedy that we've all had to manage through over the last 3 years. I think as they come on the back of managing through the pandemic, you're going to see people who've been have not been able to leave their country for 3 years, have not really been able to have normal activity for 3 years. You've seen, you'll see industry really pick back up. And so that could actually spur a lot of economic activity, which might, on the one hand, make it so that actually all of our economies get strengthened, because if that consumer is coming out and buying things and having experiences again, that's great, but it also could put more strain on inflation. So I think that's the one unknown that we don't know yet, and it'll probably be something that comes towards the latter half of the year. But I still think that the U.S. economy is very strong and will withstand the current rate increases. We're getting back to normal rates. So now it's a matter of capital allocation decisions that are just a little bit more conservative, but frankly still very healthy. And I'm looking forward to having a normalized environment for a period of time.
Well, and this is really, it brings to the heart of, well, what's the role of finance in a recovery, or what's the role of finance in a normal time, right? If you've got normalized rates, and what hasn't been normal as far as the role of finance that you've seen grow up during the low rate era. And so, Governor, I want to start with you. What do you think is excess, and what do you think is appropriate in terms of the financial system?
It's not that easy to answer this interesting question, Lisa, but let me perhaps look back at the past and take two elements. First, we had the great financial crisis, and we shouldn't forget about it. And at that time, we had to enhance regulation. And we will keep this regulation. So probably finance working and banks working with a too low level of capital and of liquidity was abnormal, to answer your question. And the new normal, with these new requirements, will last. Second, about the level of interest rates. I will say it with a smile, and perhaps off the record for one sentence.
Sure.
But when we had low rates, and extremely low rates, for, let's say for the last 5 or 6 years, at that time, nobody praised central banks, and I don't ask for praise. And there were even criticism, remember, about the financial stability risk, and why do we have in the euro area negative risks, negative interest rates, which are difficult to explain, etc. But now we go to normalization, and perhaps beyond normalization, with some tightening in monetary policy, And now suddenly, everybody discovers the past as the good old days with this low interest rate. Yeah. And it's why I completely agree with you. There is a tendency to consider that the past 5 years were a normal situation. They were not. They were exceptional. And accommodative monetary policy was fully warranted because we had serious deflation risk, including with COVID. Remember where we were 3 years ago, March 2020, there was a serious deflation risk. So we had to act. But we cannot consider that the recent level of interest rate was normal. So to give a last remark, which is slightly more technical, what we consider to be normalization as central banks is to have a so-called neutral rate, where we don't stimulate inflation, but we don't tighten either. There are significant discussions about the precise level of this neutral rate, because it's not observable. I will give you the Banque de France estimate. It's around 2% in nominal terms for the euro area. It's a bit higher in the US. So we are there. So we ended last year, and we were very fast. We ended the so-called normalization phase to normal. We are now in a new phase, which is less of a sprint, but more of a middle distance run to go to the terminal rate and to stay there for as long as necessary. It's a bit more sophisticated, the second part, but we are a bit beyond normalization, clearly.
Well, so then there's a question of how much washout needs to happen before the rebirth happens. I mean, because there has been excesses that have been built up over that period. A lot of people would agree. And so as we talk about the role of finance, it's also in weeding out some of the companies that might not necessarily have been financed appropriately. And so I'm curious, and Roelof, I'd like to go to you on this. How much more do we have to go in that washout of companies that perhaps got financed in an era that was, to the governor's point, abnormal?
Well, I think we're going to be careful, at least from my point of view, to talk about the role of finance, because what we do is venture capital, and it's a very small part of the universe where we help entrepreneurs build businesses. So it's a small part of that. I think when I think about finance and interest rates, it's about allocating capital to appropriate resources. And part of what I saw in Silicon Valley over the last few years is low interest rates meant that money was free. And companies hired too many people, too many ideas were funded, and it was rational for many of these founders to think on an infinite time horizon. And every project, whether it had a 5 or a 10-year payback period, got funded. And clearly, in a more normal interest rate environment, that's not sensible. So we're seeing more rational allocation of capital. Many of the big companies that overhired are pulling back. I don't think you're going to see an immediate reallocation, by the way, because so many companies got financed in 2021 when the going was good. And when we look at our own portfolio, which is probably quite representative, only 1 in 5 companies needs to raise money in the next 12 months. There are a large number of companies that are very well financed for the indefinite future. And it's unfortunate in some sense. If you think about sort of Schumpeter's view of creative destruction and the reallocation of resources, it might be that a lot of resources are trapped, at least for another year or two, before they free up.
Which means that you don't think that there's going to be a really wholesale washout the way that there could be, for example, in public markets with a huge sell-off in equities or something like that?
I don't think you're going to see that. In 2000, there was much more of a washout. There was a very sharp decline. Companies hadn't sort of fattened their balance sheets the way that companies did in the last couple of years. And so I think it's going to take much longer for it to unwind.
And Adena, from your vantage point, a lot of the private companies waited a lot longer before they went public and they counted on the public markets. I mean, are you seeing any kind of shift in that as companies rethink what the appropriate form of capital is in the new cycle?
I would start with the investor, right? So the markets are driven by investors, and you have to understand their psyche as they're managing through the roller coaster ride that we've seen over the last few years. I think on the one hand, in a market where money is free and the alternatives to equities really don't offer much of a return, there's a huge push towards the equities markets in terms of trying to drive return. And also, you know, that whole notion of doing what we call discounted cash flow analysis, like what is the future? They're always trying to predict the future. So they have their models and they discount back the future potential cash flows of a business back to current money. Well, when interest rates are extraordinarily low, that discount rate's really, really low. And as a result, they can kind of, the valuation of those companies becomes, you know, inflated, you could argue, on the back of that lower discount rate. well, if we're getting back to a normalized rate environment where money does cost money, and you have to think about capital allocation in a more disciplined way, the discount rate also goes up. So that changes the overall investment thesis of an investor. So that's what you've started to see in the markets in terms of the valuations coming down. But I also would say a lot of companies, that became almost like I don't want to call it a washout, but just a broad-based sell-off, as opposed to a discerning decision company by company. I think now, if we get to a point where we can actually understand what the rate environment is, I think you're going to see investors actually coming back and saying, okay, I can now pick which companies I think are going to be winners, which ones are going to have scalable models where they're going to have a clear path to profitability, which ones have businesses that really are leaning into the future. They're going to be able to re-underwrite those in a way, and I do think that you're going to see that the markets improve on the back of just having a known rate environment. And I think that'll happen. And then in terms of the private capital, that's a different thesis now. Acquisition values are different when you have to actually think about your cost of capital when you're making that decision, whether you're a strategic or a private equity investor. So I think that whole valuation model will solidify and will become more known, but it may not be at the peak of 21. I think that's probably pretty clear.
If I can maybe weigh in quickly. As we've looked at the changes in public market valuations, between 80 and 85% of the negative change is attributable to interest rate changes rather than a fundamental forecast of the company's earnings. That's really the major driver of the change we've seen. And so now it comes to the point of discerning which companies do we think have earnings potential. There's a lot of other analysis that shows that the correlation coefficient on the way down for tech companies was very, very high. And so to your point, there isn't a discernment between the relative quality of businesses. And so a lot of investors are now starting to pick apart these companies and trying to pick the winners. And then the last point I'll make about the private companies is one of my partners has this great expression that just because you haven't gotten on the scale recently doesn't mean your weight hasn't changed. And there are a lot of private companies that are looking at their 2021 weights, and at some point they need to get on the scale. And the truth is, I actually worry, I don't think there are going to be many IPOs for the next year or two, because many of these companies need quite a number of years to grow into the valuations that they were awarded a few years ago.
Well, I think some companies are facing that music pretty well and changing the value. They're kind of proactively bringing down valuations through their private rounds.
That's hard.
And we do have 200 companies looking to go public this year, so we're hopeful that we'll see more activity in the latter half.
Well, you guys can hash out the IPO market in a minute. But Michael, I do want to get to you, because underneath this is the consumer, right, for all of these companies.
Right.
And one thing about this cycle is that consumer leverage has actually been very low. And that has been one huge tailwind, because you haven't seen the over-leveraged investor that suddenly, the over-leveraged consumer that suddenly was left in a hole. How much willingness is there to lend now to the consumer at a time when people are using their credit cards to cover the gaps so that they keep going on those experiences that they missed out on during the pandemic?
Right. Just for everybody's clarity, one thing I would say, Mastercard does not lend.
Okay, correct.
Please do not come with any applications for cards, so I cannot help you on that. But looking at the overall ecosystem, it's very similar to the earlier conversation, is what has been a normal rate and where have we been? On credit card write-offs and so forth, we have, to the day, been below the historic average. So what is currently happening is that you see increasing credit write-offs around credit cards around the world, but it is approaching the historic average. So currently, right now, there's no tightening on credit in our banking partners as far as we can see, and their earnings calls, I think, have generally represented that. So no tightness on credit. Back to adding to the gives and takes on where the consumer stands, that is a give in terms of there's still flexibility. But the trade-offs on what's the mindset of the consumer at this point? There's still willingness at this point to tap into savings and tap into the credit, because you want to make up that lost time and what you haven't done in the last 2 years.
So when does that become dangerous, right? I mean, we lived through this, and now suddenly it's not a problem. So when is enough enough? If people, for example, use their credit cards to pay rent, or if, for example, people use their credit cards to make payments on their car, at what point is this a problem?
It's a point at a problem when people overstretch themselves and make irresponsible solutions. Sometimes, the individual takes that responsible decision themselves, but what actually helps is systematic answers, and that's responsible lending, that's rules and banks that know how to do this. That is in emerging lending solutions, buy now, pay later. It's regulation around new tools, new borrowing tools and so forth. So systematically addressing this through the sector, which the sector has been doing for many, many years. So I'm not worried around that.
On Square with that respect in a second, but
we
Governor,
can, can come back to that.
you have something to say.
No, perhaps two short clarifications, because obviously interest rates and monetary policy are very important for finance. But the two clarifications I would like to make and to explain perhaps how we central bankers think. First, I'm sorry to say that interest rates are very important for finance, but we don't decide interest rates looking first at finance. We look at inflation. And I'm sorry to say that because this is a round table about finance and with very, very important components of finance, but our compass is inflation, clearly. It can have different effects on inflation, and what you said about now risk premia coming back, etc., is very important. But it's not a key part of our decision. And second, we look at the financial side effects of our interest rate decision, and this is what we call financial stability. And this is what we are in charge of, especially addressing the question you just raised about the credit cycle, etc. But fortunately, and this is an innovation of the last decade, perhaps not everybody is aware about that, we have also other tools. We don't have only monetary policy to deal with financial stability. We have so-called macroprudential policies, regulation, etc., which we developed strongly in the last decade. And this is a way we try to keep our compass, which is inflation, I say it very clearly, but looking at the side effects and incorporating the side effects on finance.
So given that, are there particular areas, and I think, for example, of the crypto space that has gotten very much in attention recently, where you see the need for more intervention from some sort of financial stability standpoint?
To put it in a nutshell, we made tremendous progress on banking regulation and interest regulation after the great financial crisis. I don't say that there are no risks, but banks and insurance are more solid than 10 years ago, without any doubt. If I have one worry, it's not the only one, but a number one worry is non-banks and non-bank financial intermediation. Crypto platforms belong to that, but it could be about money market funds, about hedge funds, etc. Perhaps private equity, but as you said, it's a small part. No.
I'll let you respond. I'll let you respond
just
in
to
a
say,
minute.
let me be extremely clear. The great financial crisis was a banking crisis, and so we focus logically on banking regulation. The non-bank sector developed, and it brings something with several different aspects. But if you look at the recent episodes of financial instability, they are all in this non-bank financial intermediations. Think of the dash for cash for money market funds in March 2020. Think of these LDI derivatives and what we discovered in UK last September. And think of the crypto platform. So we have to focus here and to regulate, not exactly in the same manner. Some banks' regulations are not relevant for non-banks, but here it's our priority number one.
Would you like to respond or comment on sort of what needs to be...
I said nothing specific about
No, in terms of the role of regulation for some of the private markets, in particular the crypto sphere, as we look at how to create an important stream of finance to a lot of companies, but also make sure that there is enough discipline to make sure that it's not with undue risk.
It's such a delicate balance, because at some level you clearly want to have the protections and provide stability. I think markets benefit from stability, but you also want to encourage innovation. And certainly when I was at PayPal or in the early days of Square, as we were trying to onboard all these merchants that couldn't process credit cards, we felt like we were asking for forgiveness the whole time. And it was too slow to ask for permission. And so that to me is where you want to strike the right balance to encourage innovation while not jeopardizing the stability of the overall system. And in some respect, if you look at the meltdown that's happened in crypto last year, I mean, it's probably $1 trillion of asset value that evaporated last year, and it didn't cause any systemic problem. I mean, at some level, that's actually something to be happy about.
So you think that the regulation in place is sufficient to really allow for the correct framework?
In crypto, I think it actually begs for more regulation to enable it to really flourish. And I think a lot of the people in and around the crypto space have actually been asking for that. I think, unfortunately, it's been very slow in the US to progress, and it's frustratingly slow.
Lisa, if I can just come in on that. The crypto space has largely been driven by specialist players. And the absence of regulation has led to the fact that private sector, particularly private sector banks, have been stepping back and not engaging on that. But if you look for a path to scale, you got to bring everybody in the end. It's not just interesting technology. So I think what we're going to see on the back end of the crypto winter is exactly as the governor just said, more clarity and regulation. And you will start to see private sector banks coming in, players like us coming in and say, all right, this is promising technology. Let's forget all the noise. Let's try and scale that. And regulation will be the guardrails to scale it. So I think we're at a juncture in the road to make this a formidable ecosystem that can solve a lot of problems.
Yeah, I would agree with that completely. I mean, I have to say, I think that largely institutions have stayed out because of the fact that there are no clear rules of the road. And frankly, within the crypto players that do exist, that are specialty players, but also the business models that were created. Being an exchange operator, I know where we have conflicts of interest, and there are a lot of conflicts of interest within the models that exist in the crypto space. And I think that needs to be very clearly defined. What are each of the players allowed to do? What are they not allowed to do? How do you kind of create the right governance, eliminate conflicts of interest, and then create some rules of the road that allow for more established players to enter the space, have the banks come in, have institutional investors come in, have exchange operators like us come in, so that we have a way to kind of mature the space. And that way, it really does become a critical part of the payment layer. It becomes a critical part of the financial infrastructure. And I think there's real promise to it, but regulation is critical.
Governor, did you want to comment on something?
We could discuss at length what do cryptos bring. They bring new technology, obviously. I would tend to make a difference between stable coins, which could be one day means of payments, and unbacked assets, where the question mark is probably more significant about their value added. But let me say one thing which is for me very striking. If I look at public authorities globally for the last year, probably 1 year ago the debate was between regulation or non-regulation of these cryptos. Now the debate is shifted. It's probably between regulation and prohibition. And there are important voices, take India, who chairs the G20 this year, who speak of prohibition. So it's probably one reason more to go quickly on a serious regulation. And I agree with you, Roelof. I would wish the US to be still quicker in this field.
Well, hold on a second. Just to clarify that, do you think that stablecoins, yes, need to be regulated, but would you be for prohibition of some of the other?
No. I think that regulation is probably, but with a different content for stable coins and unbacked assets. But again, if you look at the shift of mood among public authorities, prohibition was not mentioned 1 year ago. It's now mentioned by important voices. I still think with the FSB, we work seriously in the Financial Stability Board on this question of cryptos, that a serious, a consistent, an internationally implemented regulation is the best answer. But it should come as quick as possible.
Well, but this really raises an issue for investors and frankly, financial institutions that are going to make big investments in the space, right? Because if there is the potential regulatory uncertainty, how do you make an investment in a big way in something that could theoretically be rejected in its entirety from, a major government? I mean, and Roelof, I'd like to ask you that, because this is something that you do.
We've stayed away from the speculative asset piece because I think that's the one that probably is going to end up in prohibition. Apart from probably Bitcoin, where I think it may emerge as a store of value and a sort of a system of mutual beliefs where enough people believe it's valuable, therefore it has a $400 billion or $500 billion market cap globally, not dissimilar from gold as a digital gold equivalent. But for the other categories, we mostly look for applications. And I realize crypto means many different things to different people, but we see applications in file storage. So right now on Filecoin, for massive data sets, it's less expensive than storing data on Amazon's S3 service. You can have file storage that is immutable. So you can do things like the Internet Archive and not have people go and alter with history. There are applications for anonymized communications. So there's an email equivalent of Signal, for example. There are payments applications. So if you think about international money transfer, I've seen applications in some of our companies where we can do an on-ramp from a regulated bank, use Bitcoin and the Lightning capabilities to get money to another country, back into another regulated bank with full KYC instantly, far less expensively than current money transfer solutions. So there are lots of applications that I think are really interesting.
I imagine that both of you as well have been doing the same kind of thing, right? Because I believe that you have a system where you can transfer different crypto assets and are going to continue to invest in that.
I think that the promise lies in the underlying technologies, definitely not the cryptocurrency as such, certainly not the unbacked one, as the governor said. To your question about scale and investment, and what is somebody looking for? Predictability and how far can I scale that? Now, if the US is behind, let's talk about every other country where they are on this scale. So nobody really knows, will there be interoperability? Because that's in the end, if you want to solve cross-border payments, for example, which Roelof just gave us an example, if there's no consistency in regulation, if there's no interoperability, brings us right back to the G20. The G20 have actually an opportunity right now to look at what happened in the last 6 months and say, okay, the promise of technology, what are the things we need to do? Bring trust back into the system, ensuring the rules of the road, interoperability, consistency in application of the rules. And then I think one last thing is it's important to pull in inclusion, because if this is something that lives on the fringes, that's not cool. But if you can solve a cost problem for a lot of people that want to send money back home to their family, all of those things are part of a dialogue that should be had right now. If people agree on that, I think then this technology is going to make a huge difference.
There are at least 1 billion people on the planet who have mobile phones and are unbanked. That is staggering. And so that is part of the promise of being able to offer low-cost financial services to the underserved.
But it also requires resiliency. So that's the other, I'd say, that's the other thing that we have to look at as the whole space matures. Right now, the markets are the intermediaries that exist today. If you really are in need of being able to extract your coin out of something, or if you really want to use this for digital assets, you can't have it not available to you in time of need. So that resiliency, that resilient infrastructure, organizations like yourselves, ourselves, others, where we know how to operate in a hyper-resilient environment, that really allows the space to mature. It's also very important.
So as we move forward, and Governor, I'm curious from your vantage point, when we talk about the role of finance in a recovery or just in a future environment that perhaps has a more normalized,
in the economy.
In the economy. That sounds like we're going to spend the whole panel defining the panel. But I am wondering, from your vantage point, the central bank's role as the counterbalance to the cycle, if we had to go so far to get to a place where we were normal again, right? Can we go back to an era where the central bank can act as a tailwind by dropping rates to the same extent that it has in the past? Or is the era of negative yields and the era of using that tool so aggressively over?
Never say never, Lisa. But the omen, if I look at the next years, are probably that we won't see negative rates for the next future. Let me say it this way. For a simple reason. Against our compass is inflation. We had a decade of extremely low inflation, too low inflation, and again, dangers of deflation, which is another lethal disease for the economy. I think we will win this battle against inflation, and I took this commitment of going back to 2% by 24, end of 24, end of 25. But it doesn't mean that we will come back to the too low inflation we had before. The new inflation regime will be very probably around 2%. If I look at Europe, if you look at the evolution of wages, for instance, the increase was very low in the past. It was between 1 and 2%. In our expectations, Banque de France, after coming back to 2%, we could have an evolution of wages, for example, of 3%, which is 2% of inflation plus 1% productivity. And so it would be a more balanced regime. I don't say that we will be at 2.0 each year in an ideal world. This does not exist. And we will have inflation volatility because there are shocks. But the new inflation regime will be quite different from the previous decade. This is why I wouldn't expect the result to abnormally low rates in the next future. But we'll see.
So then that raises...
If we could have a panel in 4 years, we could discuss the issue.
We'll arrange that. We'll see where we are in 4 years. Adena, I'm wondering from a vantage point, do you see more companies leaning on public markets than they used to in some ways? Because the lack of an abnormally low rate means that money is more selective and looking for more vetting before it gets placed to work, or do you see it sort of kind of remaining in the same kind of role?
I think that as the world gets used to a normalized rate environment, as we make capital allocation decisions on the back of a normalized environment, and also recognizing that if we're dealing with a more normalized environment, we're also dealing with economic growth. We're managing through an economy that should be relatively strong. And so in that environment, I think that we have seen past decades where we've had very robust IPO markets in that period of time. You know, the entire decade of the 90s was a really interesting decade for the capital markets, and the interest rates were around 5%. So in the United States. So it's not that you can't have vibrant, exciting public equities markets in the context of a normalized rate environment. But today, there are a lot of ways that companies can raise money. And I'm a big believer in that. I'm a huge believer in the VC community. I'm a big believer in the private equity community. I think that we all play a role in financing innovation, in financing growth, and creating jobs. And so if we can all operate we're all going to operate in the same way. I think it's just a matter of making sure that the public markets stay inviting for other reasons. Don't over-regulate companies that come to the public market. Don't make it extremely onerous to be a public company. Those are more the things that we focus on in making sure the public markets stay vibrant, not so much whether the rate environment will really impede it.
Do you think that the tech component will be smaller, or at least the big tech component will be smaller?
I'm a huge believer in frankly, the technology ecosystem of the United States and of the world in general. But I mean, the U.S., we have amazing innovation that occurs at every level and every company. And the one thing to think about in terms of the larger technology companies is when you're a VC firm, and I look to you, and you're trying to underwrite a new investment, and your only exit is an IPO, and your exit is not an acquisition by larger tech companies, that changes your investment thesis from the start. So having the ability to have M&A as part of the world of tech and the world of innovation, and allowing larger tech companies to bring that innovation into their organizations is a big part of our economy. It's a big part of underwriting the risk that VC firms underwrite. So I'm not a believer that we're suddenly going to have a big breakup. I think we should harness the capabilities and the innovation that occurs at every level of technology, including big tech.
And Michael, I know that in a lot of ways your company is a tech company because you're looking at the data in all ways. Okay, in all ways, your company is a tech company, and so in respect of using the data that you get from consumers and from businesses to try to allocate capital, or allow other people to allocate capital, I should say. How is that going to play a role? What type of sort of technology are you looking at to more accurately assess where money should travel?
Right. I think taking consumer data to see where consumer preferences are going is an easy one. But in terms of payments, I mean, everybody's using payments, from large companies to medium-sized companies. So across the whole economy, we see where flows are going and what the use cases are. That's a pretty good indicator on where funding should go. From our own perspective, how we make capital allocation, it's really to say, all right, right now, as we're coming out of 2 years of COVID, as we're coming out of a time where we're debating if we're going in a recession, yes or no, but we're certainly going into a high inflation environment, what is everybody's trying to do is they're trying to stay close to their customers and their partners and trying to kind of regain the consumer. So what does that mean? That is a question around, how do I offer the right kind of service, good, whatever I'm trying to do? Personalization, real-time personalization. So that is taking the current ecosystem and making it work a lot better. So there's a lot of technology at play. There's a lot of data at play. That's where a lot of our customers are going. That's banks, that's fintechs, and so forth. You look further out, you look into alternatives on the payment side in the broader economy ecosystem, new technologies and so forth. But right now the focus is really on making work better what we have at our hands. We're moving from a crisis reaction to better solutions for SMEs that have been the hardest hit and so forth. So there's a lot of near-term focus in terms of capital allocation in our broader ecosystem and in our own company, which will be at the heart of call it a recovery or just where the focus needs to be right now.
Right. And Roelof, I know that you look at a lot of companies through that lens as well, trying to look at the data and understanding what actually has the capabilities to move forward. I am curious in the next cycle whether there will be as much money for upstart companies, right? It goes back to sort of this theme of how do you foster innovation at a time of normalcy or restraint, as some people might say, who've lived through the past decade, right? I mean, is there going to be a lot less available for a venture capital infrastructure that really has blossomed in a zero-rate environment?
I think there's enough capital available. And going back to what normal interest rates are, and we invested in Apple in 1978. Interest rates were over 8%. We invested in Cisco in 1987, right after Black Monday. Interest rates were over 8%. We invested in Google and PayPal in 1999. Interest rates were 5.5%, 6%. We invested in Square and Stripe in 2010. Interest rates were, 3, 4%. So, I mean, this is very normal from our point of view. So I don't think that makes a big difference. The rate of venture capital investment right now is about $65 billion a quarter, which has returned to the level pre-COVID. So 2001 was a clear aberration, but we're back to normal levels, candidly. And so I think there's enough capital. A lot of money was raised over the last year or so. There's a lot of dry powder sitting on the sidelines. So I think there's more than enough to fuel the innovation and the entrepreneurs that want to build great businesses.
Are we going to avoid a default cycle
On
some of the smaller companies that really grew up in that era?
In what sense a default cycle?
Well, I mean, this is the big question, is are we going to see companies that got financed during really low rates, that got really good rates, that were able to
absolutely.
succeed?
But I mean, our failure rates have always been high. So in our venture business, 40% of the time that we make an investment, the company doesn't make it. 40% of the time. And that's been true for decades. And so might it be slightly higher in this cycle? Possibly, but they're wonderful ideas. These people are building incredible businesses. And so, even though I was the most negative on the panel about the likelihood of recession, I'm an optimist by nature because we meet two people with an idea and help them build a business. So we've got to be hopeful for the future.
Governor?
No, I completely share your answer, and I think this point is extremely important because we central bankers hear the criticism saying, look, while you increase interest rates, you will kill innovation or diminish innovation. If innovation relied on extremely low interest rates, frankly, it's very fragile. Innovation is about new ideas, it's about value added, it's about technological disruption. It's not about low interest rates. And there were probably overvaluations of some startups, of some companies. We didn't raise interest rates to correct this overvaluation. But if it happens, frankly, it's not a catastrophe. We need innovation more than ever, but it's not dependent on the level of interest rates. I couldn't agree more, but I think it's extremely important that we make the point in this panel.
Okay.
So, in all my time in venture capital, one of the favorite questions I ask an entrepreneur when I first meet them is, what's the inspiration? What was the eureka moment that gave rise to you wanting to start this company? And I can tell you that in 20 years, I've never heard somebody say, interest rates are low.
Well, maybe someone will say because interest rates are high. I just want to finish up. We only have about a minute left, but I do want to get a sense of where you're sort of expecting things to go in terms of inflation going forward, since that is what you're focused on. And I know that this isn't the bread and butter necessarily of the financial system, but it kind of is too, because it really relies on price stability, a lot of these businesses. So I just want to finish with a yes or no question. Do you think that we are going to get back to 2% inflation in the next decade, or are we operating now in a new, higher inflationary environment? Governor, I'd love to start with you.
Yes.
You think we will get back to
The answer is go back to 2%.
Yeah.
Yes, without...
That in Europe or U.S.?
I said for Europe, but I would be ready to take the bet for US too.
Okay.
But I don't want to speak on behalf of my colleague Jay Paul. But yes, without any doubt. Again, it's not only our forecast, it's our commitment to all of us, and it's our mandate, don't forget. It's why we are there.
Michael?
And it's our common interest.
Right. I've fallen before in the yes and no trap on a couple of occasions, but I do think yes is the appropriate answer.
Yes. Okay.
The answer is the appropriate answer because I do think central banks, regardless of which country in Europe, elsewhere in the world, will continue to rise rates until there is cooling off the economic activity. And I think the cycle of 10 years is a safe bet.
Okay. Roelof?
I say yes as well, although I think 2% is the floor, not the average.
Interesting. That's where we get down to at
Right?
some point. No, that's not what he's going to say. He's going to
It's
say
a
average.
target. It's a target.
It's a target.
I'm a little less optimistic that we'll get down to a sustainable rate of 2%, only because I do think there are a couple other inflationary factors, long-term inflationary factors. I do think the energy transition is a long-term inflationary factor that we haven't yet really factored into what that means for investment and capital allocation, capital commitments across the entire system. And that's a multi-decade transition that we have to really focus on. And then I also think that we are starting at a pretty high level right now. So to get in 10 years, likely, but not necessarily. And I would expect that we'll be more in a 3 to 4% inflationary environment, at least over the next 2 to 3 to 4 years. That would be my expectation. But I could be wrong. I mean, it all depends on the determination.
Lisa,
We're out of time.
Us said, let us have an intermediate assessment in 4 years.
Okay. Fabulous. We'll
When
put
this
it in the
panel comes
diary.
back.
Exactly.
Yes,
Thank you so
we
much.
will be back.
Thank you so much for being here. Thank you all so much for a great panel. Yeah, there we go.